Then the shares in Silicon Valley Bank is a publicly traded entity, dropped 60% on Thursday, then another 60% on Friday. Of course, then the entire world got focused on this, and then every venture capitalist started telling, or I would say the overwhelming majority of venture capitalists told their founders to get their money out of SVB. Then you had a classic run on the bank. A small number of venture capitalists gave advice to say, hey, we should support Silicon Valley Bank. I understand that, but it turned out to be really bad advice. And then trading was halted on Friday morning pending news. And then finally, the FDIC shut down Silicon Valley Bank at noon on Friday. And there's a lot of speculation of what will happen on over the weekend. But maybe you could walk us through technically what happened to Silicon Valley Bank and why they had this cash shortfall.
Chamath Palihapitiya, Jason Calacanis, David Sachs, and David Friedberg, who are seasoned professionals in their respective industries, avid gamblers, and close friends, and delve into a diverse range of topics covering economics, technology, politics, social issues, and even poker. In this video, they delve into the reasons behind the collapse of SVB and analyze who should be held responsible for the entire scenario. On March 10, 2023, Silicon Valley Bank, SVB, suffered a bank run that resulted in its failure, marking the second largest bank failure in U.S. history and the largest since the 2008 financial crisis. In light of this unprecedented event, numerous customers are understandably concerned about the safety of their funds. In his recent tweet, Sachs mentioned that the truth of the matter is that if Signature Bank had gone under a day before SVB instead of a day after, everyone would have understood clearly the risk to the banking system. And all of the phony demagogues on both the extreme right and extreme left wouldn't have had a word to say about the bailout. In his statement, Sachs highlighted that Gary Tan was explicit in referring to the event as an extinction-level occurrence, as he recently tweeted that this is an extinction-level event for startups and will set startups and innovation back by 10 years or more. Before proceeding further in this video, please make sure to click on the subscribe button below to stay updated with our latest content.
You're seeing probably thousands of companies now cannot make payroll in the next few weeks because their money is trapped and tied up at Silicon Valley Bank, which is now under receivership. So if you wired your money out yesterday, you're good. And a lot of people managed to do that, but there are a lot of people who had wires in the hopper, didn't make it. Today, logged into the website, can't log in. Their money's just frozen. And we don't know when they're going to be able to get their money out or how many cents on the dollar they're going to get. So basically, the whole startup ecosystem is in peril. I think Gary Tan called it an
extinction level event.
Yes, exactly. That was a good term. And just to be really clear, this is not big tech at risk. I know there's a lot of people out there who don't like the idea of bailing out big tech.
This is not Google. It's not Amazon.
Exactly. Those companies have plenty of cash. They're fine. This is small companies with 10 to 100 employees. And you're looking at maybe thousands of them just being wiped out for no reason. They didn't do anything wrong because of this. This could have a very damaging effect on the startup economy and the whole United States economy. This is little tech. These are the future companies that will keep the United States competitive versus China and the rest of the world.
They were so desirous of profits, venture capitalist Chamath Palihapitiya said on the All In podcast. Several months ago, the Federal Reserve's decision to increase interest rates sparked trouble at Silicon Valley Bank. Silicon Valley Bank, SVB, recently undertook a rebalancing of its balance sheet by selling off tens of billions of dollars worth of predominantly U.S. securities. This move is expected to create a ripple effect in the financial sector and could potentially lead to significant changes in the market. The shares in Silicon Valley Bank dropped 60 on Thursday and another 60 on Friday. According to Chamath, somewhere along the way, the risk folks at SVB just made a really large miscalculation. They basically went and bought 10-year risk in order to pay back money that could be called on a daily or weekly basis.
That a balance sheet business like SVB or an insurance company or any business that has, some amount of money coming in that sits on the balance sheet and then they invested for a period of time, there's a laddering of risk and there's a laddering of duration that you have. And so if you look at Silicon Valley Bank from the update they did last week that triggered all of this, if you look at SVB's loan portfolio, 70% are really these asset-backed loans, which are 56% of the portfolio is like, prepayments on LP commitments. And then 14% is private banking loans, which is loans against, public securities that people have. Only 10% of the portfolio is venture debt, which is $7 billion. And, look, if the asset historically has performed at an 18% kind of rate of return, what is the your venture debt portfolio going to look like in a distressed environment? Is it negative 100%? Is it negative 50%, negative 40%, negative 30%? I mean, you guys can have a point of view on this, but look, I mean, for any business that's managing a large balance sheet of assets against, a short kind of liability tree, they're going to have some riskier assets. I think, the question is, was 10% too much of the loan portfolio?
Silicon Valley Bank reported total assets of around $209 billion and total deposits of approximately $175.4 billion as of December 31, 2022. It is currently undetermined how much of these deposits exceed the insurance limits and are therefore uninsured. The events surrounding Silicon Valley Bank demand a thorough, transparent, and swift review by the Federal Reserve, Chair Jerome Powell stated in the announcement. The FDIC is working to gather more information from the bank and its customers to determine the exact amount of uninsured deposits. As per the regulations of the Federal Deposit Insurance Corporation, deposits over $250,000 are not covered by the government insurance guarantee. The Biden administration has taken swift action in that regard, with the president announcing on March 13 that America can have confidence that the banking system is safe. Your deposits will be there when you need them. No losses will be borne by the taxpayers.
So it's a rational decision when confidence is lost to take out your money. And in fact, it was rational. There were a bunch of VCs, not a lot, but some of them tweeting yesterday that, SVB has been a great player in the ecosystem for 30 years. We should show our support right now by not taking our money out. Well, guess what? What happened to them? They got stuck and now their money is frozen and they're not sure whether they're going to get, pennies on the dollar or not. Whereas the people who rushed for the exits yesterday got their money out.
It's a prisoner's dilemma.
It is a prisoner's dilemma. But here's the thing. It's not even about anymore whether the institution is solvent. It's about whether there's confidence. And I think there is a risk now of contagion spreading to these other regional banks because people aren't sure. And there's already huge cash outflows leaving these other banks because why take a chance? The game theory of it is move your money out until this is over. And if you're okay with, moving it back in a few weeks, if it turns out not to be around the bank, that's fine. So a lot of this can be self-fulfilling. You have to remember that runs on the bank, Friedberg, you said this 100 years ago, were extremely common. Every decade, there would be a giant financial panic and there'd be a run on the bank, run on many banks. And the only way that the federal government stopped it was by introducing FDIC. And they said to depositors, your money is safe. And at that time, $250,000 was enough. The problem we have is that with these business banks, $250,000 is not enough. So all of a sudden, there's going to be a crisis of confidence. If you think a business bank can go under, again, you're just going to leave all these regional banks. You're going to go to the top four, and that's going to be it. So I think that the situation right now is really dynamic. And if the Fed does nothing and just says, these depositors should have known better, the loss is on them, then I think the rational reaction for depositors at all of these other banks would be just to leave. Because I don't think depositors are in a good position to assess the liquidity and creditworthiness of a bank. I just don't think they are. I think stockholders are. They're the people who should lose all their money if the bank goes under, but not depositors.
There's no denying that the collapse of SVB is a complex issue and multiple factors have contributed to it. However, the primary responsibility lies with the bank's management who failed to implement adequate risk management practices and violated banking regulations. That's all about Today Analysis. It is not appropriate to assign blame or identify a singular reason for the company's collapse and bank run, as there are likely a variety of factors at play. What do you think about SVB implodes and who is the reason behind its sudden failure? Share your thoughts in the comments section below. If you found this information helpful, please consider giving this video a thumbs up and subscribe to our channel. We look forward to bringing you more updates in the future.